So we got the existing home sales data this week. Should investors be worried?
No, not at all. In fact, I think there is a total misread going on what's going on in the housing market. I read a number of comments on how people are almost saying that now this is a sign that the economy is going to slip again, et cetera, et cetera, et cetera. I think that number it's a January number. It's for contracts that have closed. So excluding the cash deals, which was about 23% of the sales, which is about average, most of those sales went into contract in November or December before mortgage rates came down. Mortgage rates were up very, very close to 5%. They've come down to about 4.5%. But they didn't really come down until late December or early January. So I actually think that the housing market is in the process of bottoming and is going to start to turn higher. Why? Because you had in November, you had the data point that the average price of a home sale year over year has declined from November of the prior year from 340,000 to between 305 and 310,000. That's actually a positive sign because it makes housing more affordable. You have mortgage rates declining, and if you look at the action of the home building stocks, they've had a very good move off their lows, like a lot of stocks have, and if they can hold that will be a sign that investors are projecting 6 to 8 months out into the future. Also, where this number yesterday was an existing home sales number, about a week to 10 days ago, a home sales number that indicates basically things that are just going to contract, or contracts that have been signed but not closed. That number beat by over 100,000. So I think it's typical that a lot of people have just this natural instinct to focus on the negative data points rather than some of the positives.
I'm glad that you brought up the home building stocks because we're going to have Toll Brothers and Home Depot report next week, and so I'm wondering, after their reports, do you have any idea of what we can see from the sector?
Well, you're certainly going to want to look at their guidance. A lot of these executives that run these companies are very hands-on. They see what's going on right at the ground level. And the interesting thing about that sector is if you take it's a great example of the dichotomy between the market and the economy. Because the aggregate market cap of the home building stocks that publicly trade is a very small percentage of the S&P, certainly comparison to other major industry groups. But the entire home building market can be a very significant part of the economy because of all the collateral action and jobs that take place through all of the contractors and subcontractors, the electricians, plumbers, HVAC guys, drywalls, painters, people that put in carpet, landscapers, and just everything else that's involved in the completion of a house and then everything that goes into it later. I think that in 2005, 2006, the peak of the housing market, people might have thought it was like 20% of the total economy. So right now, I would bet it's maybe, I don't have the data fresh, but I would say it's maybe like high single digits. So the numbers, getting back to your question, it'll be very interesting to read their comments on what they're looking at going forward, particularly in relation to the decline we've seen in mortgage rates and the better affordability of homes versus 12 to 18 months ago.
Now we've got some more trade talk meetings later on today,
Sure.
And so I'm wondering, you said that yesterday was a rout, that it ended down, and going
Well,
forward...
I said it was anything but a rout.
Anything but a rout.
Because the breadth of the market was actually not that bad. for a decline of 0.5%.
Okay, and so what about next week? What do you expect?
You're going to see more headlines. You're going to see more speculation. I think they're going to try to control what information out of these meetings comes out, so that you don't get these conflicting headlines that one person says, oh, they're really far apart, they'll have a lot of issues to resolve, and another person says, we're making a lot of progress. Both could be true, and I think that whether they come to an agreement on March 1st, they'll probably have some joint statement around March 1st, and obviously it's much easier to come to an agreement on how much stuff China's going to buy versus how much stuff they've been buying in the past than it is resolving the intellectual property disputes that go on and the privacy concerns with some of the Chinese companies, particularly in the tech area that operate around the globe, really. So when you hear President Trump say he's not, against March 1st is a soft deadline, you could very likely see an agreement on a number of things and a framework toward resolving the deeper issues, maybe for another month or so. In fact, I think there was a headline late yesterday that the Chinese officials are shooting for a Trump President Xi meeting the third or fourth week in March.
I'm glad that you bring up headlines, because my question of the week to everyone that I've talked to is, should these headlines be affecting the markets in the same way that they are currently?
Well, they're going to, but there is no doubt that with all the that a lot of algorithmic trading goes on in the market, and some of these algorithmic models or formulas have headline reading apps embedded in them, okay? Now, if a great example of, and does it create ridiculous volatility at the moment? Yes, it does. And frankly, there is very little liquidity at the market supplied by the current day specialists that you see standing all around us here that they now call direct market makers. That process has become kind of a joke, okay? A great example of that was after the Fed minutes were released on Thursday, okay? The Fed minutes came out at 2 o'clock. It took people to read them a little bit, and then you had the market go to new highs on the day, and then down to new lows on the day, and then back to where they were before the minutes came out, all within a 15-minute time span. Okay, so that's one reason why I would tell anybody that's at home investing for themselves or trading for themselves to almost to very rarely enter an order without a limit on it, because you can get totally irrational price movements at any point in time, including right around the opening and shortly thereafter, because the market structure right now is very broken.
Okay, and we've got headlines such as like the Kraft Heinz, which was down when I checked this morning, almost 30%. So I'm wondering, is there anything in this market that's scaring you?
Look, the Kraft situation, and I'm not up on exactly what all the news is, but anytime you see headlines that talk about nefarious accounting practices or the SEC investigating accounting practices, that is a major red flag. And definitely there are investors that will sell first and ask questions later, and sometimes in those situations that is not the wrong thing to do. Okay? Accounting issues, unexpected senior executive resignations, and are two things that will definitely put investors on the defensive for all the right reasons. In terms of other things that might scare me in the market, look, I think the economy is in better shape than probably the consensus. And I think, but a lot of people have been talking about how the market's going to slow down. The economy has slowed down. Last year, we printed 4.1 and 3.5 GDP back to back in the second and third quarter. We're not going to print that this year in the second and third quarter. But we're not going to go into a recession in 2019. In fact, I would say we're not going to go into a recession in 2020. There's the employment picture as evidenced by the weekly employment claims yesterday hitting 216,000 after being as high as 239,000 for a couple of weeks. Obviously, the shutdown impacted that. The employment picture is just, the underpinnings of it are too strong for us to go into a recession.
Thank you for joining me.
You're very welcome. It was nice talking to you.